two important pieces of inflation data came out this week. First, the producer price index came out on Wednesday. It came out a little hotter than anticipated, with an up 2.7% year-over-year rate versus the anticipated 2.3%. Secondly, the CPI, the consumer price index, which is more widely followed, came out on Thursday, and that information came out a little higher than anticipated, but basically in line with a year-over-year 3.7% versus 3.6% expected. And then the core inflation rate was right in line at 4.1% versus expectations at 4.1. So slightly higher on the PPI and basically in line on the CPI. The markets took this in stride originally, even though the PPI was significantly hotter than anticipated. And generally the PPI will spill into the CPI over time. So that's basically something people worry about. But they took it into stride. However, when the 30-year Treasury bond auction came out later on Thursday afternoon, that bond market went extremely poorly, one of the worst bond auctions of all time, and rates spiked after that on the 30-year Treasury. As you know, the federal government is running nearly a $2 trillion a year deficit. The debt is up to $33 trillion a year. So there's a lot of treasuries coming to market. And this is being hard for the market to digest, as you've seen higher interest rates. One of the reasons for a higher interest rate is the Federal Reserve, which in 2008 had a $800 billion balance sheet, now has a $8.9 trillion balance sheet as of the beginning of 2002, and is now down to a little under $9 trillion currently. As the Fed stopped its quantitative easing and went into quantitative tightening mode, interest rates started going up, and we have a situation that over that time frame from the beginning of last year, January 2022, to currently, interest rates have moved up significantly on the 30-year Treasury. The 30-year Treasury rate has moved from 1.9% to 4.8%. That is a very significant move and a very big increase off of an extremely low base. But one thing to keep in mind is that this 4.8% rate on the 30-year Treasury is really not a high rate. It's basically gets back to more normal levels. The 2008 to 2022 period was the extremely abnormal time frame as we're having quantitative easing, first for the financial crisis, then QE2, then QE affinity, and then you had the COVID crisis, and the Federal Reserve's balance sheet just surged, and they were buying bonds and keeping the yields down and the price up. As you can see, if you go back to the early 90s, interest rates on the 30-year Treasury actually broke 15%, and then they've been in a secular decline since then, and then got to that abnormally low level, post 2008, which is, basically at 4.8%, we've returned to a more normal level for the 30-year Treasury. The other way to look at this is if you take a look at the price of the 30-year Treasury bond, which we have indexed to 100 at the beginning of January 22, and you can see that in the red line is down about 30%. So as the interest rate has shot up, the price of the bond, the value of the bond has gone down by 30%. And we've also superimposed the S&P 500, also indexed to 100 to that same time frame. And you can see that they went down together until about October of 2022, and they both bottomed, and the price both went up for both of those items until the middle of February 2023, and then bonds started another leg down, and however, stocks rallied further. So stocks are now down about 9% over the past year and 10 months, whereas the 30-year Treasury bond is down around 30%. Historically, these numbers have been pretty closely aligned in that as interest rates go up, the price of stocks generally go down in sync with that. And the reason for that is as higher interest rates, when you have a present value of future cash flows, dividends, free cash, terminal value, that higher interest rates makes those out year dollars worth less today. So the present value today is less. That generally drives the price down of a security or a stock. The other item is higher interest rates become more competitive for investors to place their money in these higher interest rates. Now that they're 4.8% on the 30-year Treasury or 5.25% on money markets, investors now have a reasonable alternative to put their money into. So higher rates become more competitive for stocks. So historically, the trend has been when you have a spike in interest rates, stocks generally go down in lockstep. We saw that for the first 10 months of this period, and then we have not seen it over the past few months as stocks have rallied back and bonds took another leg down. So in our opinion, stocks seem vulnerable to the interest rate move that has already occurred and should be continued to be vulnerable if interest rates continue higher. Now that the Federal Reserve has stopped buying bonds and is allowing bonds to run off, basically draining cash out of the system and causing fewer buyers of bonds to be present, combined with what is taking place with central banks reducing their dollar reserves and their Treasury holdings across the globe, we do think that interest rates could move still higher and get back into a more normal level. Now, historically, the 30-year Treasury bond and the 10-year Treasury bond have yielded approximately nominal GDP. So for the sake of argument, let's say that we can get inflation back down to 3% and we can have a 3% real growth economy. That would put nominal GDP at 6%. That means a reasonable price in a non-manipulated bond market is around 6% for the 10 and 30-year Treasury. We're at 4.8, so there's still some room for upside. We don't really know how long the upside is going to take place before the Fed comes in and starts buying bonds again. My guess is that will occur at some point. I really have no idea when that's going to occur, but it's something to keep an eye on. In the meantime, stocks look vulnerable not only from the interest rate move that's already occurred, but also from possibility of either higher rates on the 10 and 30-year Treasury. To keep in mind, the market seems focused on the Federal Reserve and the short-term rates, but the longer-term rates is what dictates price-earnings ratios and valuation of stocks. And the market is now going to price in a more reasonable interest rate for those two items on a go-forward basis. So be careful with the stocks, and please take a look at our website where you can sign up for text and email alerts. We've put out a lot of written reports over the past 5 weeks, even though we did take a hiatus from producing video reports. Please take a look at the site, sign up for those email and text alerts so you get the information on a timely basis. And also take a look at our full disclaimer where we talk about this is not investment advice. We do not know your particular situation. This is what we're doing for our own portfolios, and we thought you would find it educational as you decide what you're going to do with your portfolio yourself and you make decisions about your investments. We appreciate your time. Thanks for listening, and I hope you have a great day.